I've done this before. I've built companies before. Why can I not build a firm? In 2012, I was introduced to Bitcoin because I ran a RuneScape bot farm in college. So this was like my Bitcoin pizza moment. And being a venture capitalist to me is being defined as supporting founders at the earliest stages.
What would you say was the most surprising part of fundraising?
At least with our LP base, how no one gives two fucks about your thesis. The thesis is looking at the current landscape of the world and the state of the world and saying legacy institutions are failing.
Welcome to the Inquisitive VC. Today I'm excited to have with us Alex Lin, founder and general partner of Reforge, a crypto venture fund focused on infrastructure. Alex goes from discovering Bitcoin through a RuneScape bot farm in college to building a comprehensive understanding of both traditional tech and crypto through roles as an ML engineer, product leader, and healthcare startup founder. After earning a technical MBA at Cornell focused on cryptography and distributed systems, Alex joined Shima Capital to build his institutional investing track record before founding Reforge with the mission to invest in the infrastructure that enables coordination in a world where legacy institutions are failing. In this episode, we'll dive into Alexander's perspective on crypto as the substrate for coordination, his approach to leading early-stage investments, and the philosophy behind Reforge's focus on high-velocity, high-necessity businesses in capital markets and AI infrastructure. This season of the Inquisitive VC is proudly sponsored by Carta. Carta is transforming how private capital operates, connecting founders, investors, and LPs through purpose-built software and services. Trusted by over 65,000 companies in over 160 countries, Carta supports everything from equity management to fund administration, powering nearly $185 billion in assets across over 9,000 funds and SPVs. Whether you're building a company or managing a fund, Carta is the modern infrastructure private markets have been waiting for. If you'd like to find out more, check out their website in the show notes. All right, thanks for jumping on, Alex. Really excited to have you.
Thank you. Excited to be here.
Cool. I want to start with your journey to crypto and your journey to venture capital.
Yeah, sure. So my crypto journey starts all the way back in undergrad. So I was at university, the Virginia Military Institute. So very kind of different educational system where, it was a institution that trained us to get, prepare us to go into the military in the U.S. but had an entire academic curriculum very similar to the U.S. military academies like West Point, Annapolis, Air Force Academy, so on and so forth. Ultimately decided not to commission in the military due to a number of reasons. I think cuts made by the Obama administration at the time, mixed with what I was studying, all contributed. But in 2012, I was introduced to Bitcoin because I ran a RuneScape bot farm in college. And I think like a lot of our peers, gaming played a big role. RuneScape played a big role in our lives with understanding market dynamics and trading and whatnot. But for me, I loved the game growing up, and then it got to a point where I realized I needed to actually use the game for something other than just a waste of time. So traditional bot farm where I studied applied math and computer science in school. So very quickly spun out these instances where the game would play autonomously and level up my characters. And those of you that haven't played the game, it takes forever to level up. And so it was very valuable to sell, right? So like World of Warcraft, real world selling of assets. And I had a few of my buyers not want to pay the foreign exchange fee on PayPal, which was like around 4.5% at the time. And Bitcoin and the Bitcoin block space fee, or like the fee for sending Bitcoin was much lower because one Bitcoin was like $20.
Yeah.
And so some of my buyers were like, "Hey, I'll send you Bitcoin for the accounts alternatively." And I said, "Sure. Don't know what this is, but I'm always curious about new things." And so that was my first foray into the world of losing private keys, not knowing how much money I was losing, 10 years later. 13 years later, I guess. Um, but that was my first foray into it, and then I also kind of had my next encounter, major encounter, because I was just kind of collecting it, not really thinking too much about what it meant, in 2014 when I was an intern at Dell. So Dell was actually one of the earliest partners with Coinbase Commerce, which was Coinbase's uh, enterprise partnership program where they let people buy products with a certain company using Bitcoin.
Right.
So you could buy, a Dell monitor, Dell computers with Bitcoin through Coinbase's program. So this was like my Bitcoin pizza moment where I bought a ton of Dell gear. Because I was an intern, I was like, oh, I saw like the internal portal say, hey, you could buy products using Bitcoin. And so I was like, oh, I have a bunch of this stuff. And it was like $200 at this time. So, those are the early days. But
Yeah.
fast forward, I had a whole career in Web 2. So I was an ML engineer for a little bit, led product at another startup. So I was very into the whole entrepreneurship world within Web 2, ad tech, enterprise SaaS, started my own healthcare company, all with varying levels of success. So 0 to 1 operator mentality, right? So two of those companies were acquired, another one failed, right? Kind of seeing the spectrum of being an operator, and then going into DeFi summer, decided, hey, I'm going to get into crypto full time, but focus on being an institutional investor. So two things happened. One, I went back to grad school to study cryptography and distributed systems, with a technical MBA at Cornell. And then two, I pivoted from being an operator to an investor. So those two things kind of set me up to where I am today. I joined a firm called Shima Capital, was my first institutional investing experience, and very grateful for that opportunity. And that was where I kind of built out my institutional track record, and then last year started the firm Reforge.
Very, very interesting. What led you to do the MBA?
So I think for me, credentialism was, to me at the time, was like, hey, like an important pillar towards kind of the world of finance to combine with my operating experience. But also it was actually a very tertiary thing, meaning my real goal was I want a great education. I guess a great, I guess, curriculum, um, focus on cryptography, and then the MBA was kind of like a nice benefit. So there are really only three institutions, frankly, that fit this bill. So Stanford, where you had both a great MBA program and then you had like a really strong cryptography focus. So Stanford, Berkeley, and Cornell. So I think everyone in the industry kind of has an understanding of why those three institutions on the crypto side, but yeah, and then the MBA was kind of like, okay, if I'm at these schools, then how can I also kind of give a bit of credentialism to why I would be an investor, or why I would have kind of this MBA experience to then combine with my operating experience.
Yeah, makes sense. Very cool. I guess I now I'm curious. So the journey, you are leaving Shima. Curious on the thinking on why start a new fund. Did you explore, what was you exploring kind of at that point? Were you looking at potentially joining other firms? If not, like what was the thinking of why you wanted to start Reforge?
Yeah, I mean, I remember these moments like it was yesterday, because I think just taking a step back, venture is a very interesting asset class that is very dependent on a number of factors, extraneous factors, such as the cycles of technology and innovation and how that pertains to timing of investment, how you want to structure your fund, etc. And I think that especially with crypto and the collision of crypto with other sectors, particularly finance, you have to be very conscious of what that means. So Shima was a generalist fund, and it was part of the 2021 vintage. As with some of the other kind of newer 2020, 2021 vintages, the strategy was invest in everything. Like the window of arbitrage, as a lot of investors like to call it, is invest in everything, because being a generalist fund, it gives you exposure to speculation. It gives you early access to protocols that could play the hype game, could play the narrative game. And I think that as much as we as an industry say, and we look back on that as like, yeah, that kind of destroyed us, it led us down the wrong path. That was just the nature of this asset class, or like this particular um, industry. And so, we could fault it, we could call it for whatever it was, but LPs gave us money, and our fiduciary duty was to make them more money, and that was the opportunity. Now, fundamentally, that then defines a lot of venture capitalists within this industry as asset managers, and that's why there's kind of this, hey, we're also a liquid fund, or like you got to be good at liquid in order to be a good VC. But I think that, like, maybe, I guess, a hot take is I fundamentally disagree with that. I think that it's one, very difficult to have a full stack firm, especially if you are very concentrated and smaller, right? Sure, you can have your Panteras and your B caps of the world, Paradigm, etc., that like made a majority of their capital from the ICOs or from liquid, and then they went into venture. But I think it's very difficult to do both, especially as an early stage emerging fund. And so one, that was the problem. It was, I really wanted to be focused on being a venture capitalist. So then, by having kind of this journalist mentality and then having an extremely short term fund cycle, you really don't have the opportunity to do that. And being a venture capitalist, to me, is being defined as supporting founders at the earliest stages in realizing their company goals, for the long term. And I think that crypto just provides a very interesting sandbox for that to be redefined. But that's one. I said, hey, I don't think this window of arbitrage is going to last very long, frankly. And so I need to be prepared to say, what is the next window? And one, when is it happening? And are there other funds thinking about doing this? Because when I went back to my GP, because I didn't, I was one of the first investment professionals at Shima, but I wasn't part of the docs, if you will. There was no interest in kind of executing upon this strategy. The goal was to remain a generalist fund and to kind of continuing the same playbook. But I think one of the most important things of being a venture capitalist is to be flexible and to remain and to continuously learn about how you need to navigate the ever-changing landscape of whatever you're investing in. So I just saw the window changing and saying, we can't stay the same. So that's number two, which is, I now see the new window of arbitrage coming, which is, we now no longer have this game of speculation narratives driving returns. I think that's all the talk today with the revenue meta. But I would be remiss if I didn't say that this was something I thought about back in 2022. I mean, it's what I thought about when I first started, because I come from a world in which, if you don't have revenue, if you don't have a company that people are paying to use your product for, you die. And so, very traditional tech businesses, or businesses in general. So I think those two things combined, I then had to say, okay, well, which other firm has this mentality that then gives me, one, agency, right, for me to execute upon this; two, a team that I actually want to work with; and then three, obviously, the economics associated to my participation. And no firm provided that, right? And I think it's very difficult to find one to do that. And then I just went back to my core character assessment and said, fuck it. Like, I've done this before. I've built companies before. Why can I not build a firm? And very fortunately, I had a partner, or I have a partner now, that saw eye to eye with me on everything that I just mentioned. His name's Carl Hua, who is also with me at Shima, and also an extraordinary background, to embark on this journey with me. And so it was really a no-brainer at that point to say, let's do it. Like, we believe in ourselves. We like to make bet on ourselves. And let's just get this done. And we had an action bias to do it at the right time.
Yeah, that's a really interesting process in terms of how you got there. And I think It makes a lot of sense. I had similar thinking when I was starting my fund. I guess it was quite different to the way most VCs at that point were investing. And I think the term venture is quite different, at least in that early stage of like crypto VC as well. Like I feel like right now is probably when you start to see proper venture investing, because it seemed like most funds at that point were doing a lot of liquid stuff as well. There was a big mix, right? It was mostly like a hedge funds type thing with like private
Right.
strategy, and it wasn't pure, traditional venture type investing. And it looks like we're kind of heading into that type of investing now.
Yeah, I think we're seeing a convergence of a lot of things, um, but I would say it's too late. I would say a lot of the funds that are trying to do this have already deployed most of their capital, um, or if they haven't, then they aren't prepared to do so effectively. Now, why do I say this? Because I think now we're kind of seeing what I call a temporal expertise gap, which is you have you may have like the technical know-how on the crypto side, but then you don't understand the market adoption models that will make this as successful as it can be. I think our top two examples of hyperliquid and pump, for instance, I don't think anyone saw the velocity of revenue that they've exhibited in less than a year to then result in them doing buybacks or them being able to say, hey, we're going to do an airdrop at whatever $4 billion because we have so much money, right, in our treasury to do so.
Mhm.
But then if you were to scale that down, how does that change your calculus? How does that change your thesis? Um, and so I think that like what we're starting to see is like, okay, well, obviously we want to be very conscious of revenue and combining this with traditional businesses, but I would then say the funds that have this expertise on the crypto side may not necessarily have that on the traditional tech side,
Mm.
and so I think that that gap um, will persist, and then you really need to adjust your strategy. You need to be very tactical with it, and I think many will remain liquid.
Mm.
I see tweets on my timeline talking about of like venture is still not investable, or we're still not really kind of deploying capital here, and liquid is more interesting to us. But if you really think about the outcomes, Circle is a 9-year-old business, and everyone complaining about no returns, no distributions from 2021 is still in the liquid mentality where it's like no, that if you really believe in your venture outcomes, we're not even halfway there.
Mm.
You know what I'm saying? Like we're
For
4 years in from 2021. It's like these companies should still be building and progressing in a way in which by the time they hit the 9-10 year traditional venture outcome mark, we will see outcomes that maybe align better with the traditional model. That then leads me to a whole rabbit hole of how businesses are now evolving due to AI and crypto in general being kind of helping everyone speed run things. But I do believe that that's where the mentality conflicts with liquid investors and venture, and that's
Yeah.
why I think it's been very difficult for people to see success.
Yeah. How do you think then about like token investing and equity investing as a venture investor?
I'm still very okay. So this is where we can unpack a lot. I think in terms of structure, we still stick with the safe plus token warrant combination at the earliest stages. We really do not know where the value will accrue or how the founders want to navigate that, particularly with regulation and staying compliant. Now, once again, I'll bring up and we might bring up Hyperliquid a lot, but they're doing 93% buybacks, um, and they're going the whole stake.com model of we're so big and we're so rich that if you come after us, we'll just pay a fine.
Yeah.
Um, but at the same time, not every business has that high velocity to execute such a playbook. So then for us, I think if you try to overthink utility with a token, you're going to die, right? Like, I think with this whole Robinhood introduction last week of tokenized securities and more companies realizing, hey, like, we need to be on chain and have our treasury on chain, or we need to have some representation of our common stock be represented in a tokenized format, people are going to start skipping the IPO path. So then as an investor, I once again don't care. Like, we will convert based off of whatever we believe the value will accrue to. And if a company wants to remain an enterprise business, we've structured the fund in a way in which we can still capitalize on that in a timely manner. If they want to launch a token, then we need to be very clear why that is. But I think that the latter is going to happen more and more, more and more. And, say in 10 years, I totally see a world in which today, not every company is launching a token as a representation of their common stock or their value to the company, but that number is going to get closer to 50-50 very, very soon.
Yeah, very interesting. And what about, like, as a venture investor, you're investing, in early stage rounds. How do you think about giving your investors exposure to the likes of a hyperliquid if that type of model keeps increasing in terms of founders not raising venture money and ending up to launch their own token? Is that something you would still invest in if you're not, a liquid investor?
Yeah, I would. It's part of the mandate, but like in that sense, we really have to say, why did they not raise venture capital money, and why is it liquid to begin with? Um, I don't think people realize how different Hyperliquid is. And it's a combination, like the combinatorics of their business. So perps, high velocity, high necessity business model, which we'll talk about. Two is how they were able to bootstrap, right? Jeff's background, his team's background, etc. It also aligns with their business, right, as an exchange. And then doing so in a manner in which um, that they obviously, the whole alignment with the community and like the airdrop then, and how they went to market is incredible, and the team's execution is incredible. Like, the combination of all of those things is truly like one in a million, right? And I think if you were to say, oh, like, this is going to be the norm, it's not.
Yeah.
It just will not be the norm. So I'm not concerned in any way. And if you were to tell me back in December, hey Alex, it's 7 a.m. Hyperliquid just released their token. You can buy it at $1 billion valuation. It's going up to 2, 3. Okay, it's 4 billion. It's like, now it's like 7 a.m. Eastern time. Can you underwrite this as 100x? With a venture capital mental model, so that it's a $400 billion protocol or network. I would say I can't underwrite that. I just cannot, right? So treating it as a venture investable opportunity, I could not have done it at that point in time in which it was launched. Hindsight is 2020. So could I have done things to change that outcome? For sure. Like, I definitely, for sure. But I think that, most successful funds have a near 50% loss ratio. So it's like, you either need to say, hey, like, this is going to zero, or this will literally be 1,000x. And I mean, it looks like it's trending that way. Once again, it's a great company, but to then say, okay, I'm going to sacrifice this because, we missed out on one out of a million chance, of a company, just to focus on liquid, in which everything else is zero and you can't outperform Bitcoin. Like, no, I won't tell my investors that. But I will say that
Fair, yeah.
we will stick to venture that allows for these opportunities, in which we will underwrite with the right risk management and mitigation as a venture capitalist investor. And we'll see outcomes similarly.
Fair. Okay, that makes sense. And okay, let's kind of step back a bit into walk me through the journey of, starting the capital raise for Reforge, because if I understand correctly, you didn't do a lot of like fundraising on the Shima side. So this was your first kind of go at fundraising for a venture fund. How did that go?
Yes. I mean, it was brutal. So, looking at all the factors, we started this process in 2024, where, it's a very different environment, right? Old administration, the markets were down bad. The only thing going for everyone was memes. The appetite as an LP was negative, right? People were taking money out, asking for distributions from funds. Um, we were very fortunate to have received an investment from an anchor to kind of get this thing started and to give us conviction that, hey, like, we have something here. And it was substantial. And that was kind of, that was very helpful in us kind of having that initial conviction. Um, so that most certainly was a key driver. But then for the next 6 months, it was really figuring it out. It was really saying, okay, like one, who do we need to go to? But then two, how do we turn all the interested maybes, hey, like this is a great conversation, to like a signature on the subscription docs. Um, and yeah, it was a lot of experimentation. It was a lot of conversations, right? It was a lot of kind of improvement upon, hey, like what is our strategy? And we went global, right? I was focused more on the Americas. My partner Carl was focused more in Asia. So I was Americas EMEA, and then he was more Asia. And we had more luck in Asia, frankly. Um, but yeah, it just required a lot of experimentation. But once again, I think it was in our DNA to to just iterate, like to just try things, break things, right? Literally, like we were startup founders. But venture is a two-sided marketplace where you have LPs as your customer and then founders as your customer. So then how do we sell to both? How do we kind of manage that relationship? So it was a very interesting and fun thing to do, given that we come from kind of that world.
Yeah. What would you say was the most surprising part of fundraising?
At least with our LP base, how no one gives two fucks about your thesis. Um, and I think that this specifically is also not just LP base driven, but also um, as an emerging manager, right? Less of a track record. So, you could say you have this incredible thesis, but then it's like, okay, well, how do you validate this if, your former deals may not align, or what have you? And I think that those conversations can always go down a rabbit hole that never leads to anything. Whereas shifting it to a mentality of, I need this LP to trust me, is a completely different ballgame. So the most surprising thing is, wow, like, why did I spend so much time on the deck? Why did I spend so much time talking about coordination infrastructure and like why this is going to be like literally the next life-changing thing? Um, it's frankly mostly irrelevant um, to our LP base, which is pretty diversified. I mean, we have a fund of funds, we have many corporations, we have institutions, but we also do have a lot of family offices. I think at the end of the day, it was way more relationship driven than I originally anticipated it to be.
Yeah, I think I had a similar experience too. And I feel like even the people I've spoken to, other fund managers, it seems like the case for Fund One, it is like
Yes.
definitely relationship driven, and then
Right.
each fund that comes after has a slightly different drive in terms of how to convince the investor to come back in.
Right.
Um, cool. Okay, and then curious on how you guys thought through portfolio construction for the new fund. What stages were you looking to invest at? How did you think about, diversification versus concentration?
hmm
Curious on your thinking there.
I think it all goes back to knowing what you're good at and knowing what you want to do. Uh, so given our backgrounds, our one of our strengths was we were able to get ball control, like win ball control with founders, and then keep it relatively easily. I think that's a combination of being able to build rapport with founders and saying, we've been in your shoes, and just really understanding how they're navigating what they want to achieve with them. But then also just really understanding what we're investing in. Us both being very crypto native, but then also having experience building companies, right? As I mentioned. So with those two things, it was then we want to lead. Like there's no doubt that one, we want to lead or co-lead opportunities. We don't want to be a follow-on fund. And then two, we want to do it at the earliest stage because that's where we flourished, given our past life, but then also, once again, how we win ball control with respect to getting the terms that we want, and then also, getting the ownership and whatnot. So starting there, it was like, if those are our strengths, then let's build and structure the fund around that. So if we're thinking about leading, then we obviously want to be able to write sizable checks. We want to be able to get the right ownership, and then be able to have leverage with respect to the economics. And so then we're getting in at the earliest stages. So even though as a lead check, a pre-seed lead check could still be a 500K check, right? And the upper bound, depending on the type of company, right? So if it is like an L1, or if it is very kind of core infrastructure with high velocity actions or events, then it might be pricier. It might call from a premium. So then that the math then indicates that we might need to write a larger check going up to 3 mil, right? If it's a higher value, if we want to maintain kind of our ownership percentage of at least 5%. Why 5%? Because I think that if you don't have 5%, then you're going to get outbid by larger funds. And then, like, where do you make money? The marginal buyer isn't going to buy out, your, $1 million check and $150 million valuation. Like, the math just doesn't math. So this is all basic arithmetic in our minds. And it was like, okay, well, we need to do XYZ based off of the expectations of building a $1 billion firm, right? Giving our investors $1 billion outcomes. So the math is 250K checks up to 3 mil. Knowing that the valuations that we're investing in, given early stage crypto, high velocity businesses, is between $10 million, right? Post money or FTV, right? With token, all the way up to 100 mil. And so even 100 is crazy. Like, if we're writing $3 million checks, like 5% is going to be 60, right? So like 60 was really the max of valuation that we want to go to. And then we said, okay, well, how many deals do we want to do? And how many deals can we handle as two very active GPs, right? We're not just a dump money in and then see you never. Then this goes into, okay, well, if we're going to do, like, if it's reasonable to do 20, 30 deals, then that really comes out to a $60 million fund, like $50, $60 million fund, with an average check size of 1.5 mil, 1.5 to 2 mil, with high conviction. If we need to prevent dilution, then we need to follow on, right? All this stuff in future rounds. So that was the math. It was, to us, very basic math of just really thinking, okay, this is happening, then we need to do Y. And then, but once again, right, where did I start all of this? It starts with, what are we really fucking good at? And that just requires us to get in early, be the first institutional check. And then that's where we see the most upside anyway. The multiple expansion doesn't happen with the Series A. Yeah. Right. Unless you have a multi, $100 million, $1 billion fund, which we don't have. Yeah. So that's how it works for us.
Okay. No, that makes a lot of sense. I think that gives a lot of clarity as well. And what, I guess, digging into that slightly, is what areas are you looking to invest in? What is the thesis, I guess?
Yeah. So the thesis is looking at the current landscape of the world and the state of the world, and saying legacy institutions are failing, governments are failing. And what are those two entities responsible for? They're responsible for coordination. And coordination, with crypto as the primary substrate, is not a novel thing. I think people have talked about it. It's like, oh, it's great for coordinating incentives and coordinating money. But I think it's been too conceptual. Okay, well, great. Like, so then you invest in an L1, or like, okay, great. Like, so, but like, no, right? And I think that that's where we then differentiate, which is, we can all agree that right now the inflection point is AI is going to change things. Geopolitical conflict is changing things. Economic dislocation will change things, and legacy institutions will fail. So then if crypto is going to step in, how does crypto step in most effectively? And that's where we say, it's going to be in infrastructure markets, specifically capital markets. And I think that's very obvious in DeFi and financial infrastructure. So I think within that realm, we can immediately say the continued evolution of DeFi in which crypto is a substrate for coordinating money, payments, et cetera, stablecoins. So all of that, I don't need to get into because I think that's most people's theses. Um, the second is labor markets. So coordinating people. And this can come in different forms more explicitly, right? Like ownership of IP. And I'm not just talking about an IPL1, right? Like, I'm really talking about, okay, like there's going to be a gig economy 2.0 in which there will be billion-dollar companies with just one person managing, agents, a team of agents, that have incredible outcomes. But then how do you manage the labor associated to those agents, but also people, right, in other companies, both from a money flows perspective, but then also from a data perspective, from a IP perspective, et cetera, et cetera. The third infrastructure market is compute and energy markets. So, and I think that this is where like a lot of the DePIN narrative comes from. And so we're very interested in DePIN, but I would hardly call it that in its current state. But coordination of energy and compute is, once again, optimal for crypto. And then I think underlying all of this, right, once again, is why money is so important. It's why data is so important. And so we see kind of coordination around data. And I think that comes in two forms. The first is I don't really like breaking into infrastructure application. I think it's just this idea of, and I've said this a few times on this call, what types of companies sit in this kind of realm of coordination with high velocity and high necessity? What are those two properties? The first one is very obvious, right? So with Hyperliquid, with some of these, the evolution of DeFi, you have high velocity of opening and closing positions. You're trading all the time, right? Like you literally have so many events that you can extract capital from or charge a fee to. So really high frequency set of actions or events that take place within your business. And so in that instance, about coordinating money. And the second is high necessity. People want to retire. People want to make more money, right? So there's always this necessity of capitalizing on human greed. And so when you think about like high necessity, then like it's also touching on, so it's like the Reid Hoffman investment strategy of the 7 deadly sins, greed, envy, you invest in the 7 deadly sins because like that drives demand. So when you combine the two of high velocity and high demand businesses and you place them in this world of coordination, you realize, holy shit, there's this is the future state of businesses of, okay, like you're going to have companies that will have high velocity of packets delivery, right? When it comes to AI and compute, and it's high necessity because AI is going to be running the world very soon. On DeFi side, don't need to repeat myself, but it's like you have so many businesses with hyper gambling and casinos that will always have high velocity and high necessity. And all of this, once again, is like, well, we're going to start seeing this become more open source, more decentralized, more trustless, more permissionless, in which crypto is the substrate for coordination that like we've kind of just now given it something tangible. We've given this kind of conceptual idea in an applicable body to then invest in. And that's what we do. So that is the firm's vision and thesis, because I think that there's going to be so many things to invest in as a firm. Fund one is predominantly capital markets because one, we have to be very conscious of timing. I think labor markets and all of that other stuff is just not going to time well with our outcomes of, an 8-10 year fund. So like we have to be very conscious of timing. And so I think capital markets is predominantly the focus with a little bit of AI, compute, energy, and so maybe some other tertiary stuff, right? With privacy features, high security features sprinkled in. So financial infrastructure is like really core to us, but then I can see in fund two, labor markets being kind of the primary focus, right? Or some of these other areas, these other infrastructure markets.
Yeah, very interesting. Quite exciting, actually. Final question I have is, what's a secret obsession of yours that nobody knows about?
Secret obsession. Wow. Yeah, so this is hard for me to answer because, I think like obsession is such a strong word. It's actually it's like one of my early questions to founders. I ask founders this all the time. I ask them, do you think it's more important to be passionate of what you're building or more obsessed with what you're building? Uh, but I won't say which I won't say which one I think is more important. So, but anyway, I think it's tough to say. Okay, obsession. I mean, so many things. Okay, I'm obsessed with good food. I'm obsessed
Right.
with music. Um, both as a player and as a listener of music. I'm a classically trained pianist. So I'm obsessed with like just quality, like how does sound open up your mind. So maybe that I'll just go with that one. I think I'm obsessed with just like the relationship between sound and your mental like state and the opportunities of how like sound impacts you both emotionally but as well as physically. I have this whole thesis that AGI is missing sound. Like we're like age like we are not at AGI yet because everything is very text driven,
Mm-hmm.
right? Everything is very like
Yeah.
yeah, like textual like whereas if you were to integrate sound, right? Like God said, let there be light. It's like sound is what makes all of this humanizing and like
Yeah.
truly gives us consciousness. So anyway, I could talk about that forever. So I'm obsessed with sound, apparently.
Cool. That's a really interesting one. But yeah, well, thanks for jumping on, Alex. I think this was a really
Yeah.
interesting conversation. Um,
Yeah. Thanks for having me. Super fun. Always love chatting with like-minded people. So I appreciate you having me on.